Arguably, the most important coverage for employees to have is long-term disability. Monthly disability benefits are payable after a short-term eligibility period is satisfied. Most plans provide coverage up to age 65, while some might provide a maximum payout of 5 to 10 years. And group plans are not impacted by any private insurance coverage. The eligibility period, the waiting period, for example, before payments can be paid is typically coordinated with short-term disability or salary continuance to avoid duplication or a gap in income replacement. Members are often eligible after, say, 4 to 6 weeks waiting period being the elimination period. The replacement level of disability is a predetermined schedule, which can range from 60% up to 75% depending on the taxability of the payout. For taxable plans, you typically see a 67 to 75% replacement, whereas non-taxable plans are 60 to 67% replacement. What's important to note, though, is the maximum replacement is limited by the all-source maximum, which is why most non-taxable plans should use a tier formulary to ride the 85% net income restriction. And we'll talk a little bit more about that later. For an example, an old tiered formula we've seen might include 67% of the first $2,250, 60% of the next $2,250, plus 50% of the remainder. Most newer programs would look like 67% of the first $4,500 and 50% of the remainder, maximizing current tax tables, and for ease of calculating payroll deductions. Flex benefits may provide choice of LTD coverage for much larger plans, say 400 employees or more, where members can opt in for higher coverage if they choose to pay the upgrade cost. The goal of any long-term disability plan is to ensure you're maximizing the coverage to reduce the financial hardship of a disability, which also means ensuring the plan maximum does not discriminate against higher income earners, where the maximum benefit is below the target replacement level. Just as with life and AD&D coverage, long-term disability plans have a non-evidence maximum, which is the maximum amount a member is guaranteed. To qualify for additional amounts, members must satisfy evidence of good health, typically a health questionnaire. Even if declined due to poor health, the amount up to the non-evidence maximum is provided and cannot be revoked by the provider. The definition of earnings for group disability is typically the same as life insurance. It's important to ensure incomes are not overstated or include ineligible incomes like dividend, overtime, or bonus unless specifically underwritten into the policy. Standard practice for providers is to pay out on the basis of what's reported or what the actual income is. So overstating or understating the amount of income is a liability around plan administration. Long-term disability benefits are typically reduced by any amounts the employees can receive by Canada Pension or Quebec Pension Plan, any amounts from WSIB or workers' compensation, any amounts from continued earning income or retirement income as applicable. Understanding that return to work is part of a rehabilitation program and may have a different integration. The rates for long-term disability do reflect that integration. That question gets asked quite often. Indirect offsets would be the tax benefits enjoyed due to qualifying for the disability tax credit and reduced expenses associated with not working. Again, the all-source maximum. And you can see the difference between a taxable and a non-taxable using the gross or the net amounts. The definition of disability is the most important feature of a long-term disability plan because it determines how an individual will qualify during the stating period. The most common definition is a 2-year own occupation period whereby the employee is unable to perform the duties of their own occupation and then subsequently based on the inability to perform any other occupation for which the individual has education, training, or experience. Lesser plans may include an any occupation, and enhanced plans might include a 5-year own occupation. For highly trained professionals, you may want to consider an own occupation to 65, but this is much less common in the marketplace and difficult to obtain due to the level of protection being provided. Cost of living adjustment feature is just that. It's an adjustment to help protect claimants from the erosion of cost of living increases while on claim. Consider an employee who is 30, who goes on claim and may never return to work. they will continue to receive that qualifying benefit until age 65, assuming they continue to be eligible with no adjustment for cost of living. That could be fairly catastrophic to financial planning. While the cost of the feature can be 5 to 25% of the basic pricing, it does provide tremendous value for the claimant over the long period. Pre-existing conditions clause. The pre-existing conditions clause with long-term disability is typically included in most plans and is designed to protect the provider and the policyholder against the adverse selection of a new plan member going right on to disability due to a pre-existing condition that they had before becoming eligible for benefits. The most common pre-X clause is 312, which means that any disability within the first year resulting from medical treatments during the 3 months immediately prior to the effective date of coverage would not be covered. But once the employee has been on the plan for 12 months, the pre-X condition is removed. Most disability plans include a waiver of premium, which will remove premium payments while on claim and may even refund premiums during the elimination period. Recurrent disability is defined as the accumulation of disability periods during the elimination, which is often limited to no more than 2 weeks separation of periods not working. During the benefit payment period, should a disabled employee return to work and then become disabled for the same issue, the benefits may be payable without having to satisfy a new elimination period. This often has a limit of 6 months between periods of disability. Rehabilitation clauses often allow return to work income to integrate with disability benefits to encourage people to stay or return to work, and often have an offset of 50% of T4 earnings, and some will even provide a top-up to ensure 110% of combined replacement of pre-disability earnings to encourage that return to work. Typical exclusions and limitations on group disability plans include failure to participate in an approved rehabilitation plan, injuries resulting from a criminal offense. Self-inflicted injuries and attempted suicide are often excluded, but it's important to note, provisions are being adjusted by numerous providers to take into account mental health-related actions. Disabilities occurring during a strike, layoff, or leave of absence can also be excluded or limited. Most long-term disability providers take both a proactive and a reactive approach to disability management, including embedding features like employee assistance programs, wellness programs, to try and intervene before a condition results in a claim. Most plans have rules regarding encouraging rehabilitation, ensuring no gaps between income and disability benefits, ensuring adequate adjudication of the claim, and maintaining regular contact to manage the risk and encourage a safe return to work. Rehabilitation is a key part of the program to help to utilize return to work as part of the recovery. Establishing limitations and facilitating treatment where required, as well as treating the whole patient, especially where there's a risk of dual diagnosis, which is far more prevalent where pain is involved.